Welcome back to Cruder.com. In this next video on financial formulas, we're going to be going into all of the formulas that will help us in financial modeling. Let's first focus on this part of the spreadsheet and then we'll work our way down. So if we go ahead and we start in the top left, we have our initial outlay and a bunch of cash flows. So what I'm talking about here is the initial outlay of money that we're going to need to spend to therefore start maybe a business or an investment opportunity. Let's pretend we're going to start a business, and on the first day we're going to need $100,000 to open our doors. Then after creating a business plan, we found that our cash flow statements for the next 5 years that we were estimating came out with $25,000 for the 2 first years, $50,000 for the 3rd year, $75,000 for the 4th, and $125,000 in the 5th year. And this is positive cash flow from operations. So that's what's going to be happening. Now, based on this initial outlay and these cash flows, the question is should we take this investment? Now we're almost ready to answer that, but first we need to take a look at what is our weighted average cost of capital here. And I've just plugged in 5%. So let's use an easy example such as a loan from a bank, which only costs 5%. So our weighted average cost of capital is only 5% because there's only one source of capital, and that's a loan. And so we took out a loan for $100,000 and the interest rate from the bank told us that it's 5%. So basically what we need to make sure is that we're making more than 5% on this $100,000 to therefore be able to pay the interest payments back to the bank. Otherwise, if we make less than 5%, we're losing money. We're actually paying the bank more than we're making. And just as a side note, this is often referred to as the hurdle rate. Okay, so now we're ready to answer that question and calculate the net present value of this investment. So what does this exactly mean? Well, I put in here a note. If you just click on the cell, you can see it says the net present value. It's the value of the investment today, as of literally today, after discounting the future cash flows. So again, these cash flows right here, these are supposed to happen in the 2nd, 3rd, 4th, and 5th years. So what is this value of $125,000 worth as of today? Not 5 years from today, but literally today. So it should be less. So it's discounting the future cash flows to today's value using the weighted average cost of capital. If negative, the investment will not meet the rate of return minimum, which is the WACC, or also known as the hurdle rate. So let's go ahead and plug it in, NPV, and the rate is this, comma, and then we want to pull in all of our cash flows and close it up. Okay, you see this is positive, but one thing you don't want to forget is that the initial outlay is at the very beginning. We need to subtract this from this answer. So I need to plug this in. I'm just going to put it in here and say this plus the NPV. And so we see it's positive 149. And since it's positive, by definition, this means it's adding value to the firm. And it's adding value by $150,000. But you'll probably be asking yourself is, well, what is the rate of return that it's adding value? What's that percentage? I know it's greater than the 5% of my cost, but what is that percentage? And that's where the IRR comes into play. The IRR formula is pretty simple. It just starts with IRR, and if we open up the parentheses, it's just asking for values. And then in brackets, there's a guess. And this is because the IRR is kind of an unstable formula where multiple results could be returned. And that's why I typically use the MIRR. But it's good to know this formula because it still is commonly used in practice. So really all we need to do is grab the values, which are all of these values, and then close up the parentheses. And so Excel tells us that our internal rate of return is 36%. I've also put in a note on this one as well. So the internal rate of return, this calculates the rate of return at which the investment creates zero value based on the weighted average cost of capital, or the hurdle rate. So again, when the net present value, when this is 0, that means that the weighted average cost of capital is equal to the IRR. So there is no value being made or lost. So let's go ahead and continue. This rate is deceiving because the rate assumes the cash flows generated will be invested at the same rate indefinitely, which means that In this first year, I'll make $25,000, which is a rate of 36%, and I'll continue to be able to invest this cash that I've made at the same rate of $36,000, even if I'm not putting it back into the same company. This could be saying I have $25,000 and I put it in the bank, which we all know the bank doesn't give us interest of 36%. We'd be lucky to even get 1% these days. So because of this possibility, it's good to go ahead and use this MIRR formula. But before we go ahead and start typing it, let me just show you how if the IRR is equal to the weighted average cost of the capital, then the net present value will be 0. So let me just paste this in here real quick. I'm just going to paste it special as a value. And you can see now the net present value is equal to 0 because the rate of return is exactly equal to the cost of our money. Therefore, whatever we gain from the company, we're actually losing in interest expense. So therefore, we're adding 0 value to our company. So let me change the weighted average cost of capital back to 5. And let's talk about this MIRR. The MIRR formula works basically the exact same way as the IRR formula, except for in this one you can see that there's a reinvestment rate. So what we're going to do is we're going to say these are our values and our financing rate is 5% and our reinvestment rate is 5%, and we'll close it up and see what gets returned. And you can see that 26% is returned, 10% less than the IRR. And again, that's because once these cash flows are made, they are then invested at 5% and not 36%. Now, if you're not a financial expert, you may have never put together a discounted cash flows analysis spreadsheet, but I've created one here just to further detail the financial model. And so we start here with our outgoing outlay of $100,000, and what we're trying to do is this is today's value in this column. So you can see year 1 we made 25 grand. Therefore, if we discount it back to today's value of money, it's actually 23,000. And then year 2, again, this is 25 grand, but it's discounted an extra year. Therefore, it's a little less than year 1. It's now 22,000. So it keeps on going and it keeps on discounting an extra year as you go forward. Now there's a few things that I really like about laying out this discounted cash flows in this format is that you can see the present values for each of the cash flows above and you can sum them up to get your net present value. And this number 149 equals our net present value that we calculated above using Excel. So here I'm using addition just to simply sum it, while up above it's using the net present value formula. And so that's a way to just verify and check the formula is working correctly. Next, I always like to include an accumulated balance of this present value so that I can see which year I turn from the red into the black. So you can see between year 3 and 4, I finally go from negative to positive. And then lastly, I like to go ahead and include this modified internal rate of return on a yearly basis so that I can also see the trend of when does my rate turn from negative to positive. I then take these accumulated values right here and I like to chart them as I've done below. I believe that charting both of these values gives a really good picture to management the life of this investment.